Alright, welcome to today's new YouTube video. Today we're going to be talking about what a fair value gap is. So we're going to get into the idea of a fair value gap, the theory behind it, and the actual real in-chart application of the fair value gap. So let's get right into it because we don't want to waste any time. I want you guys to understand it and truly get ready to implement it into your trading for a higher percentage win rate. So a fair value gap is a theory of price action. So it's not something that the markets give out for us to trade. It's a theory that we use. So it is where an imbalance of price is formed through a displacement in the market for one direction. So price retracing into this pattern has fair value for an entry. So price retracing back into the fair value gap is a good purchase to buy, is a good place to purchase or sell, because it is a place where there is displacement and now there's extra orders there. So we are able to buy and then price will sell off or buy off from there. So we have to understand that fair value gaps are completely subjective. Although we know there's a pattern for a fair value gap, the ones that work are subjective because people will always use wrong fair value gaps and those ones will fail. So we're going to get into why they fail and why the good ones work. So fair value gaps are also created by ICT, Inner Circle Trader, and he makes it very, very complex, and this is good for some people, but for some people they need it simple to understand. So I'm going to make it simple for you guys to understand. A fair value gap is a range in price delivery. Price delivery is just price action, where price is going, what liquidity pools does price tend to hit by the session that we're in, where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame in the same range of price. So that's a liquidity void. These are some of the volume imbalances. Price can actually gap to create a literal vacuum of trading, thus posting an actual price gap. And these got to get traded back into. Almost every single volume imbalance that is created within the market is traded back into. So we have to understand that a fair value gap is simply a 3-candle pattern. So we're not going to trade it like pattern traders. We're going to understand the pattern and then implement it with confluences and other ideas and theories to make it a stronger way to trade. So as you can see on this bullish fair value gap, candle wick right here, the high of the first candle wick and the low of the third candle wick do not touch each other. There is an imbalance in price. Price never was traded here in these candles. On this sell side imbalance, we have the first low of the candle. The first candle's low and the third candle's high. These do not touch and we have an imbalance. So if price is trading here, we could expect it to come into here for a potential sell lower. And if price is trading here, we could expect it to come here for a expansion higher. But there's one specific thing that we have to understand is that not all fair value gaps work. Fair value gaps are subjective. It's up to the mind of the trader. So we have to understand what types of fair value gaps there are. So these were the two explained earlier. And we have to understand this is a BISI. And we're going to explain why it's a BISI and why this is a SIBI. So this is a BISI because it's a buy-side imbalance. So this is the buy side when price is going up. So price is going up and buy side is getting delivered because there's buy side liquidity here, buy side liquidity here, and these are all getting swept, okay? It's a sell side inefficiency because the sell side of price, which is the selling off, is not strong. There's an inefficient amount of sellers. If there was not an inefficient amount of sellers, price would have sold down here before a move higher. So we have to understand that in the second candle, price is moving up, it's imbalanced as there's a fair value gap, while sell side has an inefficiency as not being offered. And we're going to inverse this, and the same thing is for a SIBI. The sell side is imbalanced. The sell side is going down with displacement, and this place is an imbalanced price range. So with an imbalance, we need to balance it in the future, which is why we're looking for that buy side inefficiency. So buy side will come back up because this is buy side liquidity right here. All right, so understand that the buy side is an inefficiency and is not being offered at this SIBI. And the sell side is imbalanced and is holding more of the power within the market. So these are the two types of fair value gaps. There's no other ones because there's only two ways price can move. So we're going to get on to next, which is why some fair value gaps fail. And this is due to one important reason, and this is the consequent encroachment. So C.E is the consequent encroachment. So why do we use the CE? So the CE, let's get up to the first, is the 0.5 level of the fair value gap range. So we take the range of the fair value gap and we write across the 0.5 level. So as the 0.5 level of the range marks the discount of any range. So if you know anything about ICT, you've heard discount and premium. Discount is simply the bottom half and premium is the top half. So when we're looking for buying, we're looking for a discount to get hit, and we're looking for selling, we're looking for a premium to get hit. And the reason why is because market makers, they want to get a good price. They want a discount within their trades and they want a premium for their sells. So if you are in the discount, this is a good opportunity to buy. But we also use the CE to determine the power of the fair value gap at play. So if we can see, body closes mean extremely a lot because this body close, this body close, this body close, these all created the fair value gap. The wicks actually just do the damage. So let's go back one actually. So if price closes below this 0.5 level, I'm not inclined to take the trade anymore or to take an entry off of there due to the fact that it's closed below it. I want to see a wick come down into the discount, price retraces back here, wicks right down into that discount, and quickly displaces away. A candle close below here shows a tendency to go lower, and what we look like is an inversion fair value gap if we see a close below the 0.5 level of the range. So now we're talking about when not to use a fair value gap. So obviously we don't want to use a fair value gap to buy when the price closed below the consequent encroachment. We also can inverse that. We don't want to use a fair value gap to sell when the price closed above the consequent encroachment. It's very important. Let's understand that. Next, we don't want to use a fair value gap when price swept a short-term high or low in the opposing direction. So if we're on the high time frame and we're looking to buy off of a fair value gap, a BISI, then we have to understand the high time frame narrative. And we also have to understand if the high time frame just swept a high. If price just swept the liquidity of a buy side and we're retracing back in, it's not going to be as high probability because we understand that the high time frame sweep means that we might go lower. We might look for sell side liquidity now. We also do not want to use a fair value gap when there's equal highs or low in the opposing direction. So if I'm taking this sell off of this fair value gap right here, and imagine price did not close above yet, price is still in here, but we have two equal highs, perfect equal highs, I don't want to take that trade because I understand these equal highs are a very important liquidity pool that will be swept in the day. So almost every day, every intraday equal high is swept. So we understand that and we don't take a trade in the opposing direction of the equal high or low. Let's just understand that first. Maybe write your notes. We also do not want to use a fair value gap when price high time frame is not aligned with low time frame. So if high time frame, we're looking at this sort of retracement in, then I'm not looking to sell a fair value gap right here. I see this inversion fair value gap and I'm looking to buy it. So these are all signs of a weak fair value gap and it's soon to be inversed. So an inverse fair value gap, which is also known as an inversion fair value gap or IFVG. This is when price closes above the high or the low of a fair value gap. So this is the high of the fair value gap and price closed above it. So now we know that obviously it closed above the consequent encroachment and we have this ability that this is now an inversion fair value gap, which is just as important as a fair value gap because now we can use this to target buy side liquidity as in here. So we could look for a retracement down into here for a displacement back to the high. So understand the IFVG and the FVG. And there is an inverse fair value gap model that I have found the highest win rate probability in. That is Dodgy DD's model. And I will go over it in a little bit because I've kind of tweaked it to make it my own and I really like the model. So we have two, FVG and IFVG. So a fair value gap, as you can see, this is bullish price action. We have the fair value gap within here. This is our fair value gap. The low doesn't touch and the high does not touch. So it's a displacement in price right here. And we're looking for price to retrace back in. So when we see this is the consequent encroachment right here, and this is discount of the range. And as we can see, price retraced back in discount of the range. And we can also take the premium discount of the discount range to find the discount of the discount. And this is obviously the higher probability entry spot. And this is a good place to enter targeting here. But we have to understand is that if there was equal lows right here, I wouldn't want to take it. Or if price swept to high right here, I wouldn't want to take it. Now IFVG is, as you can see, there's now our SIBI. And the low and the high here do not touch. All right, they do not touch. So there's this fair value gap right here. Price comes up and trades right above that consequent encroachment. And already from here, this is where the markets trap ICT traders as well, is that people are all selling down throughout this candle. But in this candle, I'm predicting the inversion fair value gap because price closed above the consequent encroachment. Now I'm seeing this as being a change in state of delivery. So if price is able to close above this and retrace right back into the high, the open of this candle, I'm willing to purchase right here for a target of my short-term high. So now we still didn't get this inversion fair value gap right here, right? We're still trading down. But now we get the displacement up, close above the high of the high of the fair value gap, and we also close above the change in state of the order block, making an order block, or also known as a CISD, change in state of delivery, as price is closing down, and we close above a down close candle. We can also count this as a CISD, but I like to use this one. And now this is your entry candle. This is where you're entering. Sometimes price may not retrace, so usually you have to enter right off in the close, because this inversion fair value gap play is based off of momentum, and we like to play the momentum into our favor. Also, now price displaces to our liquidity pool, equal highs, and short-term highs. So I wouldn't want to take a short out of here because we also have the equal high, and we have high time frame liquidity right here. So understand this, and let's implement it now. So when to use a fair value gap? So as you can see here, this is a good time to use a fair value gap because we understand that the fair value gap right here, which was created, the high and the low here do not touch. And we can already notice that this displacement right off the bat is a good sign for this being a valid fair value gap. There's no close below the consequent encroachment. And then here we approach the 10 o'clock hour, which becomes lots of volatility. And this is on a slightly higher time frame. And we also know that there's an inversion fair value gap right here. So we have double the confluences. We have a blue fair value gap. This is the BISI. And we have a yellow inverse fair value gap. And these are both targeting the equal high buy side. So when we understand this, we are able to implement it into the markets. So as you know, yes, it closed below, but what we can play off of there is the displacement. So when we see this displacement higher, we are completely in tune with the market and we understand it. Also, it did not close below the consequent encroachment of the inverse fair value gap. And for me personally, I find more higher probability within inverse fair value gaps than fair value gaps. I like to see an inversion fair value gap and then price retrace into a fair value gap. So from here, I would have found my entry within here, and I would have found the target, the low of my stop loss, to be right under this low, because if price comes below this low and closes below it, then it would not be a good trade. And we're looking for a close. So if price closes below both of these consequent encroachments, I would be out of the trade. And from here, we get the immediate displacement up to our equal highs. So the fair value gap worked because price retraced into fair value gap, and IFVG also closed below the CE slightly. There was enough confluence with equal highs and inverse fair value gap slash this order block right here. So price wanted to retrace into this order block. And once you traced into the fair value gap, there was that quick displacement to the other side. So the next one, this is when to use a fair value gap. And as you can see here, we have this singular fair value gap created. This BISI, the low and the high, do not touch each other. Price comes down and retraces back into it. So you could enter here, but this wouldn't be my entry. Now I see price displace higher, and we're looking for a retracement. And we also see a sweep of liquidity. So this is good. We're getting a sweep of liquidity, a tap back into the fair value gap. And also, if we get really technical, we can see that price closed back into that change in state of delivery, right? This is that change in state of delivery. And this is also an inverse fair value gap right here. Because, right, this is a fair value gap, the low and the high, and it got closed above. And this price retraced right back into the inverse fair value gap and the discount of the consequent encroachment of the fair value gap. And from here, you would have found your entry. You wouldn't enter right off of here, but you would see the displacement higher, and you would see that this is a valid setup. You would take the trade. There's this previous week high. This is our last week's high, and we're going to target this because price has a high probability of taking out the previous week high and the previous anything high or low. So this would be our first take profit here, move stop loss underneath here or underneath the close of this fair value gap, and we would have had a winning trade. So why did the fair value gap work? Price retraced into the fair value gap in respect to the consequent encroachment to the tick, right? Did not close below the consequent encroachment. The wick does the damage, wait for the body close. So although the wicks are wicking down in here to the chain of state of delivery, which is this down close candle, we want to wait for the body close. And there was also a quick displacement from fair value gap with high time frame target for our take profits. So understanding this. So now we're going to go into when not to use a fair value gap. So when we don't use a fair value gap, as we can see here, we have a large fair value gap. We have a previous month high up here, and we have relatively equal highs right here. So these are good liquidity pool targets. Price is accumulating here and comes into this fair value gap. Some people might want to sell, but as you can see, price obviously closed above that consequent encroachment. It closed above it's in the premium and closed in the premium and then closed in the premium of the premium, right? If we can take we take the consequent encroachment again of this range, we find the 0.5 here, and this is the premium. So you would want to sell, but we don't want to see the body close within that. So then that happens, and we are already thinking that this fair value gap is weak. I'm looking at it to be inversed. So obviously there's more inversion fair value gaps within this range, like right here, this fair value gap inverse to the low, this fair value gap inverse to the high, but I'm looking for this fair value gap, which already showed the tendency that it will not work. From there, price inverses it, and we're looking for a retracement back in the inverse, remember? We get that retracement back in to this fair value gap right here. We don't really want to see this because this is a breakaway gap. We don't want to see this one get hit, especially not this one. We want to see price stay in that the displacement. We don't want to see a retracement already. Maybe here we can now see a retracement down here to sweep this liquidity, but not yet. Price retraces back into this fair value gap. We place our order. We target our previous month highs and these equal highs, and price displaces to our target. So why did the fair value gap fail? Price closed above the fair value gap consequent encroachment, and the fair value gap lost value, and the IFVG gained value. Price inversed the fair value gap, and then we saw that once inversed, price will run the liquidity. So last one here, and then we're going to wrap it up, but when not to use a fair value gap. So we don't want to use a fair value gap here. As we can see, this fair value gap, which we would intend to sell off of, is closed. It's closed right above. So right here, we get this inversion fair value gap. And we can see that with the inversion fair value gap, price closes back below. And so these are choppy market moves. But we also see that once we reach our kill zones, right, we're not trying to trade outside of our kill zones. We're trading within our kill zone. We get sweep of liquidity here. And here we see that, okay, price is probably going to go to one of these lows before a move higher. This is our Judas swing, our manipulation, which is what we're getting into the next video. And then price comes down, sweeps the low, sweep of liquidity, gaining ability to go higher, coming back into the inverse fair value gap. Although closing below, it's a high volatility, so we can kind of manipulate that to our favor. Also inverse fair value gap right here. And then we get that immediate displacement higher. We would know right away if we're wrong and right, because if we enter off of here, we have a 15-point stop loss right here. We would take our 15 points loss right away. But what we can see is that after this candle, we are not interested in that loss anymore. We move our stop loss to break even, minimize our risk on the table. And then we have the previous week high, which is what we target. So price closed above the fair value gap CE and lost its value. The IFVG gained its value once the fair value gap lost its value. Price swept the sell side liquidity right here before the fair value gap inversion. And then also once inversed, price will run the liquidity. So price ran the liquidity right here. And I hope this helps you guys understand fair value gaps more and understand the way that you're able to use them within the markets for your favor. Understand that these fair value gaps are subjective and they change for people to people and the way you use them. So I'm going to be going over all of ICT's concepts, and I'm going to make it sure that you guys can implement them in your own strategy. I don't want you to follow an old one. I want you guys to create one for yourself, and that's how you really become a profitable trader. Okay? So thank you guys for listening to my video, and I hope you guys took notes and actually learned something of value. All right. Thank you very much. In the next video.